to the accounting class. In this session we're going to look at inventory. Inventory may consist of at least three different things. Goods that are waiting to be sold are part of inventory. Goods that are partly made are part of inventory. And the raw materials that a manufacturer uses to make his goods, that's also a part of inventory. The businesses for which inventory is really important are really those of merchandising and those of manufacturing. A merchandising business may very often have thousands of goods which it puts on for sale. To keep track of all these requires very good procedures for inventory, so that, for example, a firm like Walmart or Target will need to keep very close track of the inventory. Manufacturing business needs to keep track of all those areas that make up its inventory, whether it's the finished goods or the various components or the raw materials. That is extremely important for the large manufacturers, such as Ford making automobiles, Dell making computers, or Kodak making cameras and other accessories. Let's consider what happens if you have too many finished goods. Large numbers of computers stacked on shelves waiting to be sold represents a large amount of money tied up in an asset. It also represents a risk because those computers could in fact become out of date. If you've got a long assembly line or a very slow moving assembly line, that again ties up a large amount of money. In other words, you don't want your resources tied up in inventory in that way. And of course, stockpiling of raw materials is again a way of tying up money in inventory which you don't necessarily want. And again, that also carries a risk. What happens, for example, if you buy large quantities of a raw material at a particular price and then you suddenly find, well, the price has dropped. Owners or potential investors should also be looking at inventory, how it's recorded, and of course looking at sales as well. That can help you make decisions about whether you want to invest in a particular business. For example, if you see large amounts of finished goods but very few raw materials and low sales, well, that suggests that there's something wrong. Those goods aren't selling. On the other hand, you can find somewhere with a very low inventory of finished goods, with lots of sales, and quite a large number of raw materials. Well, that suggests that company might be doing quite well. How do we track inventory? Well, the easiest way used to be to go around and actually count what was there. How many of each item we'd got, how much raw materials we've got. For a small business, that might still be the easiest way. If you haven't got too many goods that you're selling, you can go around and count them from time to time. This is known as keeping periodic inventory. On the other hand, for a very large business, again with thousands of items to be sold, or where the finished goods are made up of thousands of components, well, going around and counting is not going to be the easiest way to keep track of inventory. These days, many businesses will keep track of inventory using scanners and barcoding. Look at any goods that you buy, you'll nearly always find that either on the goods themselves or certainly on the packaging, you will find barcoding. That barcoding can be used when you scan goods at a checkout. It can tell the business exactly how many have been sold of which item and exactly how many you've got left. It's what's called keeping a perpetual inventory. On the other hand, even a system like this can sometimes have its disadvantages. If the only thing that you relied on were the scanning results that came through via the checkout, well, you would miss certain things. What about that box of goods that got damaged in the flood last year? What about any shoplifting that's been going on? or even possibly your own employees stealing goods. That isn't going to show if the only thing that you rely on is using barcodes. So from time to time, auditors insist that there should be a physical count of inventory. Whichever method we use for tracking our inventory, we should also remember that if we make false statements about inventory, then we've broken the law. One final point here, and that is, when do goods actually count as inventory? Let's suppose we bought 1,000 cases of red wine, and those cases of red wine, they're somewhere on a boat between France and Jacksonville. Well, when are they inventory? That's when you have to look at the terms of sale. If, for example, it says free on-board shipping, then those terms of sale imply that as soon as the goods go onto the ship in France, they're yours. You can put them on the inventory. On the other hand, if it says free on-board destination, then they're not inventory until they arrive at your business. This ends the session on inventory. Thank you for watching and listening.